Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Invesco's dynamic US factor rotation portfolio. Now, the goal of this strategy is effectively to recognize that factor investing is cyclical and to try to take advantage when certain factors are performing better and when other ones are performing worse. And before we look at the portfolio on our platform, let's actually have a quick look at the fact sheet in a sense of what Invesco is specifically doing. And what we can see over here is that effectively they have a perception of the macro environment where they effectively divide this into recovery, expansion, slowdown, and contraction. And then they allocate differently across size, value, momentum, low volatility, quality, depending on what they recognize, which type of environment we're in. So it's effectively 5 factors, different combinations. And so let's see in terms of how the current portfolio is comprised of. And what we do see is that this is effectively 5 smart beta ETFs from Invesco, where the 3 largest ones are a low volatility ETF, a quality one, a momentum one, with weights of 30, 25, 25%. We can see that the fees are, well, relatively low, and that adds up to a total portfolio fee of 18 basis points. Now, the kind of appropriate benchmark for this from our perspective is simply the S&P 500. And that is because, all of those smart beta ETFs effectively select stocks from the S&P 500. And if you look at the performance of the current holdings, right, compared to the S&P 500, we see that since 2016, right, you can see a very similar performance, slight underperformance most recently. Now, this is the performance of the current holdings, but this is not the track record because it's of course a factor rotation strategy. So Invesco would have had a different portfolio about 3 months ago, 6 months ago, and so on, right? Where we do not have the data, but we do have the performance on the fact sheet. And if we scroll to the 3rd page, we do see the performance. And in general, it's not a good sign that performance is on the 3rd page rather than on the 1st page because it indicates problems. And what we see over here is the analyzed compound returns of this strategy since inception. Now, we don't care about gross returns, we care about the net return. And as you can see, since inception in 2018, effectively Invesco's US factor rotation model has generated 7.95%. Now, the benchmark that they're using is this kind of an index, which is the US factor rotation custom index return. I'm not sure what this is. It might be static, might be also dynamic, right? But this generated 13.85%. So effectively, right, Invesco has been underperforming their own benchmark by almost 6% per annum. And we can't really explain this by costs because the trading cost for ETFs is fairly low. The fees of these products fairly low. So the only way to explain that is by exceptionally poor asset allocation decisions. And I can only speculate, but for example, we take 2020, right? So this is the COVID crisis. You can see the net return was 6% versus the performance of the index was 18%. So what I would speculate happened is that Invesco at the depth of the COVID crisis in March 2020 probably went all into kind of like quality, low volatility ETFs, right? Thinking they're safe. Then the market recovered, right? And they were sitting on kind of lame ducks, right? Especially low vol didn't work at all. Versus this index they have is probably a more static one, right? That declined as well, but just took the recovery with it. That's speculation, right? But overall, it's a brutal underperformance, right? And just highlights, unfortunately, a factor rotation model that is not working. Now, in terms of analyzing this further, I think the only other aspects that are worth highlighting is that you can look at this portfolio and also partially explain why it hasn't done much different than the S&P 500, is that this portfolio is not constructed thoughtfully. And this is unfortunately something that we do see over and over, that if you combine smart beta ETFs, then you have to be careful that they don't offset, that the ETFs don't offset the exposures. And that's unfortunately exactly what is happening in this portfolio. So we can see that the current portfolio is comprised of low vol, quality, momentum, value, and an equal weight ETF. But these strategies, they conflict. So for example, we have the value ETF, which contributes positively in a sense that it has a positive beta to the value factor of 0.53. Problem is that we can see the low volatility ETF has a negative beta. We can see that the quality ETF has negative beta. So effectively, you have zero exposure to the value factor despite having like a value ETF in here. And you can see that same thing for the size factor and same thing for the quality factor, actually. So effectively, it means this portfolio is not well constructed. The better way would be not to use ETFs for this, but to do this with stocks in the sense of using an integrated stock selection model, right? Or at least have fewer ETFs where factor offsetting doesn't happen. Now that's with regards to portfolio construction. We can also question is if the current portfolio can be reduced from a fee perspective. Short answer is yes. So for example, we can replace the Invesco S&P 500 equal weight ETF, charges 20 basis points, with the product from iShares, charges 9 basis points. So we save 11 basis points. And if we do this for the entire portfolio, we can reduce cost from 18 basis points to 7. And basically get a portfolio, right, that has the same returns. Now, final question on our side is, can this portfolio be simplified? And well, we can basically go back to benchmarking is, yes, very simply with the S&P 500. And this kind of already concludes our short analysis of Invesco's dynamic US factor rotation model portfolio. And as we've seen, this aims to exploit the factor cyclicality, right, via factor timing. But the model that Invesco is using has been, well, terrible, unfortunately, and led to a performance of 6% per annum. And therefore, and this combined with the factor offsetting by combining smart beta ETFs, right, that have opposing factor exposure, simply leads to a product, right, that is like the S&P 500, which you can buy for at a much lower cost than 18 basis points. Hope that helps. Have a nice day.